Welcome to Navigating Wealth, a podcast where we apply a high net worth lens to economics, investing, and lifestyle questions. Today's guest is Daniel Altman, an economist, founder, and best-selling author. He's a Harvard-trained PhD who writes the High Yield Economics newsletter and has contributed to the New York Times, Forbes, and The Economist. Dan is a founding investor in Calgary Wild FC. I hope you enjoy. I'm Tad Fallows.
And Sriram Gallipalli.
Matt Sheckman.
And we're thrilled to have Dan Altman join us today.
Thanks very much, Tad. It's a pleasure to be with you guys.
Typically what we do for the first 5 minutes or so here, we'll cover one of the most popular, one of the most, we think interesting threads from Long Angle over the past week. So this week there was an interesting one on realtor commissions. And as an economist, I'm sure you've got some strong perspectives on this one, Dan, with I would say traditional, quote, standard market rates for commissions being somewhere in the 5 to 6%, nominally coming from the seller and split 50-50 between the buyer and the seller's agent. And I think really the fundamental question here is a lot of people are asking, hey, if house prices now, or let's say I'm looking to sell a house for $5 or $8 million, 5 or 6% of that just seems like a crazy price. And, I think there's a lot of discussion about, hey, what are people actually spending on that? So I'm happy to kind of share my experience. I recently bought a house end of last year and really like the broker I work with. And I think there's real value to a broker who really knows a market deeply, especially if it's one that's a little more idiosyncratic, not just, hey, this is one condo out of 300 in this building and there's clear market clearing price, but some of those dynamics. I ended up just telling her that given the price point was a lot higher, that, we felt 1.5% was fair for the buyer's agent. And I wanted her to rebate anything over 1.5%. And I don't know if you guys have had any experience in this world.
Yeah, I do. Actually, the house that we live in right now, I bought using a rebate agent. So that's specifically an agent who does rebate the commission. They pay very little, or they play very little part in the buying process. You identify the house you want yourself. If you want them to visit it with you, they will. But essentially, if you want to get the maximum rebate, then they're just there at the end. And that process worked out great. There are so many tools right now for finding the house you want online. And so I didn't really feel like I needed a real estate agent to help with the search. I've done a lot of property transactions before, so I didn't feel like I really needed someone to help with the paperwork part of it. I just needed somebody to stand there and take half the commission from the seller's agent and pass that back along to me. The thing is, there really isn't the same thing on the seller's side. And yet we still have a lot of selling tools that make it easy. And now, in fact, you can list yourself on some of the bigger websites. So I think there's maybe a gap in the market there where we could have seller's agents that are offering consistently lower commissions and spending less time on it. Because after all, if you're a seller's agent, you just want to get that transaction done and go on to the next one, right? You don't even have a good incentive to negotiate. There's a big principal agent problem there in the first place. So I think that there's a gap in the market and we might see seller's agents doing what rebate agents do for buyers.
And Dan, who'd you use? Did you use a boutique agent, or was that a Redfin type situation?
Yeah, she's a boutique agent who operates in the New York tri-state area and was great.
And what does that end up costing for somebody? Is that a few $1,000s or what's the net out of pocket?
Yeah, I mean, her base was $10,000 and the rest passed on to me.
I'm surprised that we haven't seen more traction. I mean, whether it's after the settlement, where court basically found, collusion amongst the club deals and all the realtors out there. But even before that, I don't really know what it would take to really pick up steam in terms of market share for Redfin or other type of agents. Maybe we need to run the numbers and it is picking up steam and it's just a matter of time. I don't know what others think on that in terms of it actually happening. When we talk to people that are going through it, I think that there's just a significant level of concern for those that don't have a lot of real estate transactions under their belt, or maybe don't have a lot of financial experience. It's just a huge purchase, and everyone that they've ever known has used a 6% or split-based broker for the last couple decades, and I think it's probably a level of just that fear associated with it.
Yeah, but the most important thing for a buyer is really the attorney, right? If you have a good real estate attorney, they're going to make sure that you're protected and that all the contract and title information is as it should be. The broker is much less important, I think. And there are some online businesses now that are trying to do the rebate broker thing at scale. So it may be growing.
Your point around the information is interesting. As I've been following this Compass Redfin lawsuit, and I think typically I'm kind of one of these. Hey, there's two sides to the story, et cetera. It seems to me that
What's the background there, Ted?
Okay, so this is Compass. They are a real estate brokerage firm that started a few years ago. I think they initially positioned themselves as a tech company when really it was just another real estate brokerage, but got a lot of money from SoftBank to build a brokerage. So I think they're now the biggest brokerage in the country. And they have this thing where you can list your house just on their internal platform initially, and it doesn't go on the MLS. So it basically doesn't start ticking on your days on market. So the kind of pitch to the seller, and I actually worked with when I sold one house, a Compass agent, and it was handy for the sellers. Okay, you can kind of test the market here, see what the feedback looks like. You don't start to make the house look stale. And then Redfin has basically, I think, been looking around the corner and saying, hey, this is going to blow up our whole business model, or sorry, Zillow rather, saying, if we start to lose the MLS's cohesion, you get this fragmentation, then all of a sudden, there's not a single source of truth, which I think is what it looks like in a lot of markets. Occasionally when I daydream about having a place in Paris, I'll try and browse Paris apartments, and there is no kind of universal way to search. And then I think, Compass is now buying, I think, Open Door, so they'll get, even more scale there. So I think it's basically a big fight between the two of them about what Zillow is trying to do is say, hey, if you ever list on something else and don't put in the MLS within 48 hours or 24 hours, then we're never going to show it on Zillow, and trying to use their market power to sort of force people to continue in the MLS. But then I think Compass is trying to use their market power to say, no, we're big enough that we don't have to participate. Personally, I'm really on Zillow's side here because I think that I think we have a very good shared data infrastructure, which enables people to do things like Dan did in terms of just negotiating down the price. But if you start to get that fragmentation, now you got to go to a Berkshire Hathaway agent and a Compass agent or whatever agent to get a full picture. That's just a kind of dead weight loss in the economy from my perspective.
Yeah, I don't know. I mean, that shared infrastructure is also what created the collusion amongst brokers and the whole MLS system in the first place that caused the lawsuit that just happened the past years. Because what was it? If you're not going through the MLS, then you'd have buyers brokers refusing to show, or sellers brokers refusing to work with non-affiliated parties, non-realtor affiliated parties. Yeah, I don't know. The infrastructure can be a boon and a bear at the same time.
Yeah, I think there's also this aspect of this off-market transactions that happens in especially the desirable areas. So I think people are going around these things anyway, right? And so the question is that going to be something that's easier? Do you want to facilitate those things? Or are they just kind of, because they're not posting on MLS and it's sold within 30 minutes of being listed? Well, clearly there was another market behind it. So if it's already happening anyway, is it better to kind of try to bring more transparency there?
Well, who do you think is facilitating that, though? My impression is that those are pocket listings that are held by brokers, and it's just, hey, great, we never have to take this to market at all. But my buddy who's on the buyer's side, I just connected him, and then now we did this without even going through the listing process. My problem on that, like on those types of things, is that from a seller's side, they're told that they're getting top dollar and that they never have to do any work. But, the agent's incentive is to just sell this thing as fast as possible, right? And I'm not sure that you're actually getting market dynamics on those types of things. But I agree with you. I see that stuff happen all the time.
Yeah, that's a big problem, the incentive problem. And I'm actually writing about it in the book that I have coming out next year, which is called Economics for the Win. It's all about using economic tools to make better decisions in everyday life. And if you're selling, you need to come up with some other arrangement besides just a commission so that you can align the incentives between the agent and yourself, right? You want to say, hey, if you get a price above this number, then I'll give you 50% instead of 6% or 3% or whatever it is. That way their incentives are much more aligned with yours. If you set that number high enough, then I think you'll be happy with that arrangement. But generally speaking, it's a problem. I even was able to turn the principal agent problem to my advantage once as a buyer by saying, okay, I'm coming into a transaction for a property I want where I know there are multiple bidders, and I'm coming without my own agent. So that means that the seller's agent, if I buy, gets to keep the whole commission. So all of a sudden I'm in pole position in front of those other buyers who have their own agents, right? Now that agent's working for me as well as for the seller. I've co-opted them. And so this principal agent problem can be turned both ways, especially when the commission's big.
And do you find it's better to do that of saying, I'm going to self-represent? I found they like it better when you just go to the seller's agent and say, I will hire you as mine as well. Because I found the self-representing seems to give them the heebie-jeebies for some reason, either like they're going to get a bad reputation among their peers, or they think that you're going to be a clown, not know what you're doing. But if you explicitly hire them, you kind of accomplish the same thing.
Yeah.
So I think, having jumped in here, would love to kind of go a little bit broader on your background, Dan. So do you mind giving us a quick walkthrough of your career here?
Sure. Well, after I finished my undergrad, I went straight into grad school for economics, where I had the pleasure of teaching TAD, Principles of Economics. So I finished my PhD at Harvard. And then after that, I decided I didn't really want to go the academic route right away. I think I kind of didn't want to spend the rest of my 20s and my early 30s working 16 hours a day to get tenure. And so I actually went to The Economist as their economics correspondent based in London and editor of the statistics section there. I did that for a year, and then I got hired by the New York Times onto the editorial board, and then later went to the newsroom writing economic commentary. I went back to London to work as an economic advisor in the British government. Then I went back to the New York Times organization as an economics columnist, global economics as well as U.S. economics. And after that, along the way, I'd written a couple of books. I decided I wanted to be a bit more of a doer rather than a reporter, a writer, a commenter. And I went into consulting and international development for a couple of years with a firm called Dahlberg that has offices around the world. And then I kind of thought after 15 years, I wanted to get out of the regular economics business. And I went into sports. I got a bunch of sports data from soccer, started playing around with it and doing a little consulting for big groups like City Football Group, which owns multiple clubs in the Premier League, MLS, and many other leagues around the world. I worked for other Premier League teams and MLS teams here in the United States. I did some work with U.S. Olympic teams in volleyball and weightlifting for several years. Just a lot of sort of Moneyball type sports data consulting. And after that, I started my own business for an online scouting platform for soccer, which I ran for a few years and then sold. And I also started investing in soccer clubs. So I do that with a business partner based here in New York. And we had a very successful investment in England where we doubled our money and a little bit more in just a couple of years. And right now we have invested in the new women's soccer league in Canada, which just started this season. And we are both investors in the Calgary club there. I do other early stage investing, many different sectors, some sports related, some not. I'm always looking for companies that do things that are kind of unsexy and yet have the possibility to grow into $1 billion platform. And that's really what I'm doing right now. I have one more project, which I mentioned offline, which is I bought a building recently to turn into a jazz performance space locally here. And I'm really excited to get that off the ground too.
Well, a lot to dig into there. I'm curious on the, maybe to start in a particular place on the sports investing. I know we've had a few where we looked at this probably more in the mainstream sports like, NBA, NFL kind of investing where there's certain dynamics largely around, TV revenue and that sort of thing. And what's been interesting there is they've sort of moved from these novelty investments where it's cool for the local car dealer to own one to stuff that really has strong economic fundamentals and cash flow, et cetera. Sounds like what you're working on is maybe not as expensive, a little bit more secondary or tertiary kind of markets. What are some of the things you see driving the potential returns in something like, Canadian women's soccer?
A lot of it is just live content. Content is king and live content is really the emperor. If you look across all the streaming services, the things that distinguish them are not just the shows, but the live content that they can offer. That's something that can't easily be replaced. That's something that always has an audience. And the appetite for that for soccer was growing strongly for several years. And now for women's sports, it's growing strongly as well. So we think that women's soccer is a great nexus for that. And I think the other thing that drives it is the relatability. You have people who are there, athletes on the field, and people can connect with them through social media and otherwise connect with their stories. And that really is a different kind of organization from what so many of us are used to investing in. It's more like an entertainment business where the personalities are the drivers.
What kind of tools are you using in order to kind of see what the forward-looking growth or watchability of something is versus relatability? Women's sports is a good example for a long time of trying to build up the WNBA or other women's sports leagues. And there's certain women's sports that do phenomenally well, like women's soccer or tennis, but others that maybe don't pick up steam. Or then, I was having this conversation the other day with a member about pickleball, and they've had all kinds of issues with building out those leagues in that there's really no media behind it, which is where all the money comes from. But the relatability factor is huge. And so the question kind of becomes like, does anybody want to watch this? Everybody wants to play it, but is there anything behind watching it? So how do you think about that? What kind of tools are you using? I know you're getting into the data and all those types of things, but would love to hear more on that.
It's partly a cultural thing, and it's partly how much groundwork has already been done. Women's soccer has been thriving in many countries for years, and the fact that it's just kind of taken off more recently in the United States is almost a historical accident. I mean, the United States has been a powerhouse in women's soccer at the international level for many years, and I think there was that market just waiting to be tapped. We always had lots of girls playing soccer, but there wasn't a professional pathway for them, and they didn't really have those role models to look up to except on the national team, which you would see in the World Cup every 4 years or something like that. So that was really an opportunity that was just waiting for someone to grab it with both hands. And I think that the same is true in Canada. Canada is a top 5 or top 10 women's soccer country, never had its own league. So in some respects, it's kind of low-hanging fruit. Those sports that don't have as much of an established background, people weren't used to watching men's pickleball, let alone women's pickleball, right? It's something that has to be brought into the public consciousness. I think things like the Willem Dafoe Michelob Ultra commercials are probably helping to do that, but nobody's watching those tournaments yet. You have to wonder, are there tennis fans who would like to watch pickleball tournaments, something like that? We didn't have to ask those questions with soccer.
Although it's interesting with pickleball, you can, like Agassi, Steffi Graf, and McEnroe, they're all over YouTube playing pickleball, and they're really fun to watch, actually, if you ever see those. On the soccer side, I went to one of my first DC United games here in DC, and it was interesting. The ticket prices were incredibly expensive. Why? Because they were playing Miami, and everyone said Messi's going to be there. About 12 hours before the game started, he claimed he had an injury, and he actually didn't come. And ticket prices fell. Like, they fell almost 90%. Like, $1,000 tickets were going for $100 tickets and everything else like that. And it was still a great game. It was a fantastic venue down here in Audi Field. Recommend everyone checking it out. My question is more around, both with like the men's soccer team, which is, or the men's league, I should say, MLS, and then a corollary question around the World Cup coming in next year, actually. I've heard stories like, well, I'm not sure we're actually going to sell out stadiums in the US, and it'll be really easy to get tickets like the day before or the week before because it's really not as popular as anything else in the country. And curious on your outlook on, I guess, the men's leagues or just soccer in general in the United States and why you're not investing here yet.
A fun fact, I used to work for the ownership group that owns DC United, and when Audi Stadium opened, we really thought we had to have some star power, especially since the team wasn't doing that well. And it was my analytics that underpinned the signing of Wayne Rooney.
Yeah, Wayne Rooney.
And it really, really brought a different level to that club.
It totally did.
I can't vouch for anything else that's happened at that club, but that was one thing I was glad about. Anyway, soccer in the United States is in a weird place because if you look at the enterprise value of some of these clubs, they are bigger than some of the biggest clubs in Europe. Historically important clubs like Ajax in Amsterdam or Milan don't have the same value as, say, a DC United. And there are two reasons for that. One is the stadiums here are built on these extremely expensive pieces of land or very valuable pieces of land that are sometimes just ceded by the municipalities, but they're worth hundreds of millions of dollars by themselves. And there's just this expectation that soccer is eventually going to blow up in the United States and be as big as baseball or football or something like that. And a lot of those valuations are just built on those expectations. That's a lot to hang your hat on, and stakes in these MLS clubs are very expensive. Even some of the second and third division clubs are getting expensive now. That's just something where we thought there was a bit of froth, and we weren't ready to go into that.
I'm curious. It's clear to me if I could own an NFL franchise, it's just a license to print money, and that's great. How much the kind of stuff you're investing in that I would imagine is nowhere near that order of magnitude yet on revenue Is it sort of like venture investing of, hey, these things are currently unprofitable, but you're getting a lotto ticket. And if it turns out that this league suddenly, I don't know, maybe you buy a third tier British team, and if they can get promoted and now they're in the Premier League, you're getting this 10x return. Is that the dynamic, or are these things profitable, but just at a much smaller scale?
So there are a few different business models you can look at. One is this idea of promotion. As you said, in European soccer system, you can move up a league and that really increases your revenue. That's what we were looking to do with our investment in English soccer. We bought a third division team thinking if we could get it to the second division, then we would have a 3x or 4x on our hands easily. And we wanted to do that within sort of a 5 to 7 year time frame, kind of classic private equity play. We weren't able to do that because there was a corrupt CEO and some board members who were implicated as well. So we got out of there, but we were able to get out of there, as I said earlier, at a very good price, quite a lot earlier in the process than we thought we were going to. But that's a decent play. Like, that's something you could try.
Now, Dan,
Yes.
the returns on that is driven by you. Once you get promoted, you have better media profit shares, and so your just revenues are driven, or is it multiple expansion, or maybe there aren't even multiples attached to it at all? You have a Saudi prince who wants to buy any team that's in, the premier versus the lower tier, and so once you get in there, then it's a Graders Fools kind of situation.
It's a combination of stuff. Definitely the broadcast is way higher in the second division, which is called the championship, than in the third division, which is called League One. But there's also the possibility then that you could take a second division team and bring it to the Premier League, which has a lot of prestige attached to it. So yes, you're getting a big boost in revenue right away, but you're also getting that possibility that some big wealthy person is going to come in and say, hey, I want to have a Premier League team. I'm going to take this team and bring it up one more level. So both of those could be the case.
And how did you get into this sports investing?
Well, having worked around the sport and inside the sport for about 6 or 7 years, I had some connections built up. Agents in professional soccer deal with players, but they also deal with buying and selling clubs. So people start to bring you deals and you get better and better at trying to analyze the books of these clubs and see what their prospects might be. We probably looked at dozens of clubs over several years, trying to figure out what these deals might be. I did some cold calls too. That's where this investment that we're talking about came from. Actually, was after we looked at clubs and decided which ones were good targets based on their catchment areas and the types of players that they had, the types of prospects that they had. I actually just cold called the chairman of this club. He initially said no, but he came back a little while later and said, hey, I'm going to sell my shares. Do you guys want to take them? You just have to kind of get in the game and be part of those conversations. But once we did one deal, deals started coming to us on a regular basis.
And, in terms of your career path there, to rewind a little bit, going from academia, PhD at Harvard, to journalism, then to actually active investing yourself, and some seems like a bit of back and forth here. Has it been easy for you to move across disciplines there, or particularly from academia, is it sort of a one-way ratchet of, hey, if you've left the academy, you're not welcome back, and now you're a pop economist rather than a true economist?
That's a great question. I did go back. I taught it as an adjunct at the Stern School of Business at NYU for about 10 years, starting in 2009. I taught global macroeconomic forecasting. I taught the role of the private sector in poverty reduction, and I taught some sports analytics as well. I certainly felt like I could do a decent job in those things, but I haven't really sought to get back into an academic department, so I don't know how hard or easy that would be. I'd have to start publishing papers in peer-reviewed journals for that, I'm pretty sure. But, different stops that I had along the way. I spent 2.5 years as chief economist at Instawork, like you mentioned. That was great for learning about the tech sector and startup funding. And I've been able to invest in a couple of tech startups as a result of what I learned there. So it's been good to have a very varied career, because it means I have perspective on a lot of different businesses.
Yeah, can you tell us a little bit about your time at Instawork? Maybe what you learned there that the rest of us not working there, might find surprising?
Yeah, it's a very interesting company. It's a labor market platform, so it's a marketplace company. And most marketplace companies are kind of natural monopolies, right? You want to have a big company that has a big marketplace with lots of buyers and sellers. And the more buyers and sellers you get, the more valuable that marketplace becomes for both the buyers and the sellers. And obviously, the bigger the company can grow. So this is a labor marketplace for in-person hourly work. And yeah, it is growing to become essentially the 800-pound gorilla of that market. And it makes sense, right? Because you want to have the most options, whether you're a buyer or seller of labor. And learning about how to get that flywheel going in a marketplace business was very interesting. It was also interesting to learn about what kinds of benchmarks and targets a company like that needed to hit to satisfy its venture capital investors. It was also interesting to see what the processes were for growth, how people tried to grow quickly and not worrying too much about details, to imbibe a little bit of that Silicon Valley mindset, which you see Elon Musk even bringing to Washington. You see what the limitations of that mindset might be, but also, to get a taste for the funding climate and also this process of what Cory Doctorow has called enshittification, which gradually happens with a lot of platforms when they try to exploit both sides of their market to the hilt in order to gain revenue. But it gave me some economic insights too, because it was a company that really grew during the pandemic when there were a lot of labor shortfalls. They were able to fill those shortfalls and also provide income to the workers during that difficult time. And I think we may be heading for another time like that now, because we are shrinking the labor force essentially by deporting a lot of people and scaring people from migrating here. And we're also in a situation where this wave of new tariffs is trying to spur manufacturing in the United States. So we're going to be looking for a lot of kind of low to middle income wage earners. And a company like Instawork is probably the kind of company that can help to fill those gaps.
That's interesting, actually, Dan. What I thought you were about to say was more about the impact of generative AI on the entry-level labor force. I don't know how much of that you saw while in Instawork or commentary you can have. I know you just wrote about something around this just a few days ago, but the impact that's going to have, or is having, I should say, on this entry-level workforce.
Well, we saw it at our level too, because there was a big push within the company to get artificial intelligence incorporated into what we did. We already were using a lot of artificial intelligence for matching workers with jobs. And that's a really valuable thing to do in the marketplace to reduce frictions in a job market. In terms of generative AI, for these in-person jobs, which some people would call standing jobs or blue-collar jobs, it's really not a big deal. Generative AI is not going to load a pallet for you, right? Generative AI is not going to serve a catered meal for you. There are a few little things that it could do to help you out along the edges of those jobs, but all these jobs where people have to stand and use their hands, generative AI is not a big factor.
At least until the robots come for us, right? But I guess my question, especially for someone who's an economist that also has such a deep investing background, which is pretty rare, is what happens when the white collar labor has a massive hit to unemployment, and kind of what are the fallout effects of that first, second order when you look at the NASDAQ and the S&P that's just ripping, and it's based on this forward looking productivity. Maybe it's too quaint or simple of a way to look at it, but when you have such a big piece of the economy that's spending on all of this, essentially your upper class segment of the economy that makes up the bulk of spending, what happens when they're not spending anymore? Like, how does that play into the overall economic cycle tied into generative AI, and what's kind of fueling this bull market?
Yeah, there was a report out from Moody's Analytics not long ago that showed something like 50% of consumer spending was coming from a tiny percentage of high income people. I don't know if those people are really going to suffer that much from Gen AI. They probably are in a better position to take advantage of it in some ways. But there is this middle swath of sort of high income sitting workers or white collar workers who are finding that some of their jobs may be at risk. And, I don't think this is something that's going to happen overnight. If you look at the way Gen AI has spread, it hasn't really integrated itself into the workplace in a manner different from previous technologies. It's a kind of slow revolution like some of these other things. But I think that there is a risk. And to understand this risk, I think we need to look back over the last 30, 40 years to what happened with globalization and technological change. As a result of globalization and technological change, a lot of those blue-collar jobs disappeared, and that was a huge dislocation in our economy and other economies around the world that we didn't really manage. We didn't do a great job of helping those people to maintain high incomes and to deal with the forces of globalization that were displacing them from the jobs that they used to have and used to do when those jobs disappeared. So what we're seeing in terms of the political context right now is a direct result of that, right? We have a lot of people who feel kind of left out, disillusioned, and largely as a result of economic changes in the last couple of decades. So what if we had that again, but this time with those white collar workers? We'd have another group of people who were essentially left out, feeling like they've been victimized, not protected, not helped to deal with these big trends. And I think that's a very dangerous thing. I shudder to think what our politics would look like then.
I'm guessing by the fact that you posed that question that you have some hypothesis about how we might prevent that from coming to place. Do you have some diagnosis or prescription on that?
Well, last time around, I proposed that we should have a new GI Bill that would really help people who were displaced as a result of globalization to retrain, re-educate themselves, and pick up the skills that they would need to succeed in a more technologically driven, service-driven economy. Some people have been able to do that. We have a tiny federal program called Trade Adjustment Assistance that's supposed to help with that, but it's obviously completely inadequate. Mostly this works well when it happens in the private sector, but we just haven't subsidized that. We have a terrible market for training in this country anyway, because people can just easily get up and leave their jobs. So they can easily be fired. They can easily leave their jobs. So there's less incentive for companies to invest in training. We don't have a sort of apprenticeship program like they do in Europe, Germany especially. There are so many things that we could have done to help people manage that transition to a more globalized, technologically intense world that we didn't do. And I feel like we need to think deeply about whether we need to do similar things now for this Gen AI revolution.
And do you have, I think from the beginning of time, people say, okay, well, the plow now displaced 90% of farmers, so there's going to be nothing to do. And again, the mechanical engine displaced people, and that has never actually turned out to be a problem, right? Every time people get displaced from industry X, there's new industry and a place to work. Presuming that continues to happen now, do you have, a perspective, I don't know, informed by your Instawork time or others around what's likely to grow to sort of absorb that labor that's liberated?
Yeah, we haven't seen mass unemployment necessarily as a result of these technological changes, but what we have seen is stagnation in real incomes. So the problem is not that people can't get jobs, right? We've had historically low unemployment for a lot of years in the past couple of decades, but it's just that the real household incomes haven't really been rising. And so people feel that there's economic stagnation, especially when you've got this other group of people at the top end of the income and wealth distributions who are shooting away into the horizon, right? So the growing inequality has made people feel left out, even if they do have jobs. If we think about what the future may hold in that respect and what types of jobs people will find, I think that they will find sort of service-oriented jobs, because there will be a wealthy minority that's able to pay for more and more services, whether it's your landscaping or fancy hairstyling, whatever it is. Those in-person services that can't be done by AI will probably proliferate. But we're also seeing more and more people taking the entrepreneurial route because they can't necessarily get paid as much as they think they deserve or ought to be paid in a corporate job, so they strike out on their own to try and do something. Fortunately, our economy is one of the best for innovation and entrepreneurship, but that's sort of coming under threat now too, because it's becoming a little less meritocratic, because there's a lot of cronyism now, and the legal system's being kind of turned into a way of extracting money from private corporations. So I'm a little bit worried that we're going to lose that option as well.
Is there a time period that you would look back to that would say, we're operating in a fairly similar paradigm? And is that kind of cronyism, levels of, government intrusion, involvement in the economy tied to the wealth gap? Like, would you look back and say, what this is really reminiscent of is the late 1800s and the Industrial Revolution, when, the wealth gap was widening and there was a lot of underlying cronyism and things like that, and maybe here's kind of how we got out of that? Or is it a new paradigm that we're working under?
There's definitely a resonance with the Gilded Age. And so we are seeing these few people getting extraordinarily rich and becoming very cozy with government, while there are a lot of people who are being left essentially with the same standard of living they've had, or maybe even something worse. And we know how that ended up, right? In some countries, that led to revolution. In the United States, there was a backlash, and it was sort of accelerated by the Great Depression. And we had a lot of legislation that was trying to fight some of those forces. but it started even before the Depression with things like Sherman antitrust. So there is resonance there, but I even see resonance with other countries more recently. It's funny, people compare the US to Argentina sometimes now. Argentina, a place where I lived for several years. And they say, well, you've got the administration here and you've got the Milei administration in Argentina, and they're going to shake things up and they're going to cut spending and they're going to make it a much more libertarian type of system. That's not happening here. That's happening to some degree in Argentina, but here, we're actually looking a lot more like one of the Peronist administrations in recent times, the Cristina Kirchner administration, where you had high tariffs, you had big deficits, you had taxes even on exports, you had state involvement in corporations trying to nationalize some of the more important businesses in the country. You had potential for devaluation of the currency, which we're already seeing as a result of debts. I mean, this looks a lot to me like what I experienced living under Cristina Kirchner in Argentina. Nothing to do with Javier Milei, who's actually getting rid of tariffs, getting rid of export taxes and the like. So, we don't have to go that far back in history to find some analogs. And I don't know if you want to start going down the path that Cristina Kirchner took in Argentina.
And so one of the things that you do is you write this or manage this baseline profitability index, which I think the goal, as I understand, is to look across a lot of different markets globally and kind of what's attractive today for investment. So, clearly with your comments about Argentina or the US, what are you seeing given all the context of today's economy that looks maybe more interesting today?
Yeah, so the baseline profitability index is assessing the prospects for foreign direct investment in countries around the world. It uses a lot of publicly available data with an exclusive algorithm to try and come up with a baseline for what you could expect when you take into account things like economic growth, but also some of the things that can erode your return, like expropriation and corruption and financial crises and insecurity, capital controls, even real exchange rate fluctuations, all those things that could affect how much you're able to bring back into your pocket. So not just what you earn in country, but how much actually gets back into your pocket of your principal and return. And we see kind of two groups that are successful in this area. One is the group that has really good governance, where you have a really safe place to do business, an excellent climate for entrepreneurship. Those tend to be countries like your Singapores, but also your Scandinavian countries. And then there are other countries that are growing really fast. Maybe they don't have quite so many advantages institutionally, but their fast growth and a reasonable institutional climate can help, like India, for example. And some African countries, and even a few Eastern European former socialist countries. So you've got kind of two groups where you're balancing growth with these institutional factors. The United States finishes right in the middle of the pack right now. I don't think that would surprise too many people who are active in foreign direct investment, who are used to seeing higher returns than what you can usually get in the United States with direct investment. But, a country like Argentina was sitting near the bottom for years because of these institutional factors that were just garbage.
And so almost every country, I'd imagine, is experiencing some version of this. We could call it a K-shaped economy or, a lot of the same dynamics that, and post-COVID dynamics, et cetera. The ones that are being more successful at, I don't know if you're saying that's a Poland or a Singapore or something like that. What do you see that they're doing right that maybe a US or, other countries are having more challenges with?
Well, they typically focus on making it easier to start businesses and then protecting people who run businesses by making sure that they're not subject to corruption, that there's a transparent legal system in place, that they have no fear of expropriation or insider dealing by people in the government, that there's a reasonable fiscal situation, so there's not a chance of a currency or fiscal crisis, and that there's as little insecurity as possible as well. So that your assets are going to be intact. Those are all important things. And there are some countries where, as I said, that it's not necessarily the case that you have all those factors in place, but they're fast-growing countries where you actually expect real exchange rate appreciation to a large degree. That can be a big driver of the return that comes back into your pocket. And what I mean by that is, if you think about how much money it would take to buy a factory in the US right now, and you compare it to how much money it would take to buy the same factory in India, there's a big difference. But that difference is shrinking as India grows. And so your factory in India, in terms of real stuff, like in terms of factories in the US, is actually appreciating in value from year to year. That's a big increase in your return. So those are kind of the two sets of things that I've been looking at.
I'm interested in maybe Stuart might also be interested in your take on this. I think if we look at a lot of our members, you're talking about, okay, I could invest in a factory in India or, Argentina, something like that. I think typically they've been, hey, I've been investing in the Magnificent Seven or Nvidia for the past, 10 or 20 years. And maybe it doesn't require as much hard thinking, but has significantly outperformed these ideas of sort of, rolling up your sleeves and doing more of the, heavy lifting investing. I'm wondering if that's, just a sort of point in time and hey, markets are cycles and that's been a really good cycle for US growth tech, or if there's, we're going to go to a place where you need to do more of the hard work and the economic fundamentals to try and get continuous returns.
It's a great question. And I think that there are people who are more curious about what you might find outside our borders right now. Historically, U.S. investors had a huge home bias. If you look back to the 80s, something like 90% of holdings were in U.S. securities for U.S. investors. That has changed. Now it's more like 60%, I think. So people have been opening themselves up, and that's a result of, ease of investing through different platforms. It's also ease of getting information about investments. All those things have changed as a result of globalization. And I think we're going to see more interest in foreign direct investment as well. But it's already happening from people who own companies who want to do more investment overseas and more production overseas. Right now, with the tariffs that we're facing, some of these supply chains are having to reorient. So somebody who had a factory in Vietnam might be saying, oh, can I now move this factory to Bangladesh or some other country where there might be a lower tariff rate? And so you need to have an idea of how those assets are going to change in value over time. And things like real exchange rate appreciation are extremely important, especially if you're moving goods back and forth. So I think that there is renewed interest in this now, not just from an investment perspective, but from a perspective of doing business and production. The last thing I'd say about it, if we look over this, let's say, last 10 or 15 years, yes, certain U.S. tech stocks have done really well, but even gold has outperformed U.S. markets since the Great Recession. And this year, a lot of foreign markets have outperformed the U.S. just because the dollar has been depreciating so much. So there's definitely more interest in foreign markets, I would say, than there used to be.
In that respect, I've tried to slowly allocate it a little bit more like just broadly world index or like I think JP Morgan International Growth Fund, and it's still not doing, it's sort of hedging, but it's not doing as great as Tad mentioned, my Mag 7 holdings. So, the question is, as we move forward, hopefully mean reversion will happen and those things will sort of play out over here. My question was a little bit more around, private markets and international private markets, because what we're seeing here is more and more companies, I think OpenAI is a more recent example, where you just can't have access to it unless you're in the know or you can get access through someone. You're seeing more of these companies stay private. How much do you see that, or can you comment on that on the international side? If people want exposure to international markets, is buying some of these larger indices really capturing the majority of these international market growth, or are we seeing more of the same private market economics hold in these kinds of areas as well?
I think you have to separate it into the Forex play and the fundamental play. For the Forex play, I mean, I bought a bunch of German bonds earlier this year just because I wanted more euro exposure. And obviously with the dollar dropping, that turned out pretty well in a very short period of time. But if you're talking about fundamentals, it's not as cut and dried as you might think, because a lot of U.S. companies earn a huge amount of their profits overseas, and a lot of foreign companies earn a lot of their profits in the United States. So it's not really foreign markets versus U.S. markets in terms of just shares. If you want to capture a foreign market's growth, foreign direct investment makes more sense because you actually own assets in country. And so it's the asset value that's driving your return. I think that with the overall situation right now, I do think there will be some reversion. I think some of these valuations are pretty insane for the Magnificent Seven and other companies that are driving these major indices. But if you look more deeply at U.S. indexes beyond the Magnificent Seven and some associated stocks, things aren't necessarily going that great. So if you are trying to have a diversified portfolio, I don't think you can ignore these foreign options.
And you mentioned that gold has been, outperforming everything. I think that's one where I've been feeling a little bit of that FOMO. Is that largely an inflation play? Is there something more that's going on there?
I think a lot of it is an inflation play that's driven by these enormous debt ratios that we now see in most of the major economies. If we look at the United States, Canada, Spain, France, Italy, the UK, Japan, we're all running debt to GDP ratios over 100%. Canada is in slightly better shape because they have a lot of financial assets to balance that. But you have these other 6 economies that are running enormous debt. That not only sucks credit out of the long end of the market, which drives rates up, but it also raises the specter of potential inflation because some of these countries might not be able to raise taxes or cut spending enough to reduce these debts. And so they're going to have to devalue to get out of it. They're going to have to devalue their currencies, and that means creating higher inflation. And so I think that people who've just been watching the long end of this market and these increasing debts are saying, hey, eventually they're going to have to pay the piper. And when that happens, these currencies are going to be worth less. You can see the same thing happening in other markets that are potential inflation hedges, like real estate, like maybe Swiss francs or something like that. But I think it's a lot to do with that.
And what are the various trade-offs of the currency devaluation that we're seeing? For somebody who's solely US invested, all you see is up and to the right with, the S&P and other indexes. And so you're not necessarily seeing the impacts of that currency devaluation. Can you talk a little bit about that? And then, the associated potential benefits of exports and things like that, and how somebody should think about movements in your home currency or others?
Yeah, I mean, a lot of it depends on what you do with your money. If you are just trying to maximize returns in dollars and that's all you care about, then hey, maybe you don't have to diversify quite as much. But if you're actually worried about how much your dollars might be worth outside of the US because you do foreign travel or you have other things that you buy from abroad, luxury goods or whatever they might be, then I think you do have to worry about it. And, as I said, there have been big fluctuations already. I think the dollar's lost 10 or 15% this year already against the euro. So, if you had bought German bonds paying 3% or something, then, you'd be close to a 15% return already on that, which is comparable to the S&P. And while the S&P may be peaking, I'm not sure that the euro dollar rate is peaking. So I think like I said, it depends on how you use your money.
And I think, if you look, I don't know, past several decades, let's call it, I think de Gaulle called the U.S. having extravagant privilege of the dollar. And, in general, with such a large economy, if you choose to, you can sort of ignore the rest of the world, right? It doesn't really impact that much your job, your price level, your physical safety, what's happening in the rest of the world. Do you think we're still in that era, or is it going to be something where you can't choose to just say, well, if I'm happy taking my vacation to California rather than Paris, I can kind of ignore what's happening elsewhere? Because I think, is that still a viable strategy?
We can't fully ignore it. The U.S. is less export dependent than a lot of other countries, but for consumers, still about 10 or 11% of what they buy is coming from abroad. And that's not just being driven by champagne, that's being driven by imported clothing and stuff like that. It could be at any price level. And so those things get more expensive, right? It's not just tariffs, it's also exchange rate changes that make those things more expensive. So if you think about that as 10% of your consumption, maybe more for people who buy luxury vehicles or watches or whatever it might be, that makes a difference. And so we are going to get poorer as Americans because of the depreciation of the dollar. We can't avoid that. And the question is how far that's going to go and whether we're going to do anything to offset it.
Well, really appreciate you taking the time to join us on the podcast here, Dan. If folks are interested in learning more about what you're doing, where would you point them to?
Well, they should definitely sign up for the High Yield Economics newsletter, which is on LinkedIn, comes out every Friday. It's totally free. We also have the Gross Domestic Provocation podcast, which just launched with my friends Jason Freeman, who is a very experienced hedge fund guy, ex-Goldman, ex-Citadel, and Jeremy Hudson, who's a marketing whiz who I worked with at Instawork, and he's been at several big tech companies like ZocDoc as well. The three of us are sitting down to talk about what all this economic news means for you. So from one podcast to another, you can check it out. And, look out for that book that's coming out next year from Crown. It's called Economics for the Win, Practical Principles to Help with 30 Life Decisions. So I hope all those things will be useful to people to make better decisions into the future.
And you didn't mention the tequila bar. Where does one go for that?
Not tequila. It's going to be a jazz performance space in Englewood. It's going to be called Manteca, which is an old Latin jazz song by Dizzy Gillespie and Chano Pozo. Dizzy Gillespie used to live in Englewood, New Jersey, so it's a great way to bring that jazz history back into the present. I don't think we're going to be selling tequila right away because liquor licenses in Bergen County, New Jersey can go for upwards of $250,000, but maybe someday.
Excellent. Well, thanks so much for joining us.
Thank
My
you so
pleasure.
much, Dan.
Thanks, Dan.
Take care.